Welcome to the Greenleaf Podcast. Today we are going through our industrial assets and a little bit of an overview of what we are seeing in the industrial market, specifically here in the Southeast. Most of our deals are in Atlanta, so we're going to start off with how that's going right now, get things going. So 7%.
Yeah,
That's what we're seeing, right?
Atlanta's leading the country in year-over-year industrial rent growth. So we're pretty excited to see that. You know, we're seeing that. You know, like Pleasantdale's a good example of this, right? It's like we bought Pleasantdale about 2 years ago, and in-place rents were $3 to $4 a square foot, when market's closer to 12 to 14. It's like, so Atlanta has a good amount of older stock that is able to see still good, big revenue jumps, and at the same time, lots of new stuff coming online.
Yeah, that's more than 7%.
Yeah,
But when you look at the average of all of it, 7%. But yeah, a lot of that rent growth is that going from $3 or $4 a square foot to 14.
right.
It's a monumental jump.
Yes, and if you look at the whole country, you know, the next place is DFW. I grew up in DFW, went to University
Also
of
known
Texas.
as Dallas.
Also known as Dallas, but it's 2.5 hours north of Austin, where there'll be a big game this weekend against UGA. We're very excited. I'll be there. My horns will be up. So anyone else is there, I'll see you on Saturday. Anyways, back to the podcast.
Yeah. So no, DFW, I mean, it's a strong market. They're performing well on industrial, but it was interesting. LA is down. So kind of nationally looking at industrial and in the flex space, it means a lot of different things, and it's very different across, different markets. If we take that where Atlanta's going really well on this, we know there's lots of opportunities where rents are low and can be reset to much higher rates. We've got to talk about what type of asset that is, right? So there's obviously the giant, when you think, most time you see industrial, you think 300, 500, 700,000 square foot ginormous warehouses.
Yeah, like
50
the
foot
tilt
heights.
wall that you see along the highway. Like there's a huge one with the battery factory up 85.
Yeah, SK factory up here, yeah.
Yeah, it's incredible.
Yeah.
Those are the buildings that, they just kind of, everyone thinks of as Amazon warehouses that kind of pop up overnight. You see the wall go up and all of a sudden it's a warehouse. And but these are humongous sites. And they are seeing softening demand. And Home Depot put out an article over this last quarter that they're really dialing back their warehouse usage. So home sales are down 40% since peak in 2020. And so obviously that hurts Home Depot quite a bit. So they're closing 4% of their warehouses, which ends up being 4 million square feet. They have 112 million square feet.
Yeah, they still have a lot, though.
Yeah.
But it's going to save them
$500,000 a year in rental costs. So pretty significant.
Yeah. So that's pretty good. Yeah. But the stuff that is performing well, what we're talking about here in Atlanta, the stuff that's going from $3 or $4 to $14 is all of this infill, smaller size footprints that this is the whole reason we got into the industrial flex space, is like they are not making it. They're not getting any more of the stuff built. There's no more room where you can build something infill and be a flex building. It's just not happening. So that's where we see a lot of the play right now in this space, is finding buildings that, they definitely need some work. They need some love. They have really low rents, and we don't even have to get them to market. We don't even have to get them to $14 for work. We can get them to 10. We get them to 11. There's a lot of wiggle room in there compared to saying, hey, we have to go get that. We have to go get that big rent bump.
Right. And so, specifically talking about the properties that we have, like Forum Flex, which is where we're sitting right now, or the Hub that we closed 2 months ago, or Lakeside that we closed about 18 months ago. These are all single-story office buildings with a variety of roll-up doors, or that we're adding roll-up doors to them, that are somewhere between 50 and 70% warehouse. The rest of it's office. But they're in the middle of densely built neighborhoods surrounded by single-family homes or apartment buildings. And we're delivering access to those homes and consumers is pinnacle over everything else. So going, like we were talking about the battery factory up 85, that's 45 minutes up the highway, really away from everything, which is where a warehouse should be, or a manufacturing plant should be. But when it comes to distribution, they want to be as close as possible for just that last mile.
Yeah. And we look at the size of these things. You've got the giant Amazon warehouse, but these smaller suites, we're really seeing demand for the sub 10,000 square foot space. So if we look at with two options, we kind of go through what an investment looks like in the industrial flex space. You have kind of we found a value add opportunity. It could, whatever it is, there's going to be some work that needs to be done, and it could be done in any manner. But there's going to be something that has to happen to fix it. So there's that part of it. It's got low rents. There's maybe not roll-up doors. The parking isn't great. You go in and you're fixing that stuff. That's kind of the first phase. The next phase of that, though, is where you have the space. It is divided up. It's not rented, though. You have the white boxes ready, and you could look at it and be like, wow, okay, you could move in here. There's that phase where you could either exit at that point, right, or you're going to lease it. You got to make that decision. And then the final phase is really where it is leased, it is occupied, you have a good rent roll, and you have created and captured that value. So those 3 points along the way, we liken that to multifamily in the sense a lot of apartment deals, if you're doing a value add apartment deal, all you really had to do is rent a few units. Be like, look, we renovated these 3-4 units. We got market rent for them. It's easy to do. It kind of proved the business case. And a lot of times you could capture the value on other units, even if they weren't renovated. Because you'd be like, look, I did it here. Yeah, it's basically all done then. And you were kind of selling that dream to the next person. There's a lot of that in multifamily. With the industrial flex stuff, once it's ready, and you're like, look, you could go get 14 square foot on rents on this thing, take it and run with it. It's a good opportunity to capture value at that point.
Right.
And it's faster.
We had a property under contract about 6 months ago in Norcross, and it was 5 or 6 suites. Half of them are white box, ready to lease, where you can capture top of market and add that value. The problem was that the other half of them had 5 and 7 year leases that were locked in at, say, $8 a square foot, but they were wanting us to pay top of market price based on that future leasing rate that we could not justify doing.
Yeah, it's just too far out.
Yeah.
So, okay, so overall investment, what we're still seeing in the flex space is we can basically find stuff around $100 a square foot. Some stuff even better. The hub was
65. Yeah.
so we're better. But generally speaking, around $100 a square foot, we can do the work to basically get it ready, and we can look to exit around 130 a square foot. So we can do all that work in about a year. That's current timeline that we're seeing on this stuff. If we occupy it, if we do the full lease out, if we get through all those steps, in theory, we can sell it for more because we have that next phase of the stability done. But that's really what the overall investment play is in the flex space.
Yeah, and at that point, it puts us in a really good position to sell into the market at a great premium, or refinance, hold the property, and continue to cash flow.
And we haven't. All of our stuff we're buying is existing buildings. We haven't seen any. We've seen zero new build stuff that's available. Right. So there's the supply of it's not really increasing. It is static for what it is. Right. All right. So we're gonna jump in and talk about some of our specific assets and how they're performing, and which is interesting. A lot of these tie to kind of our main points. Some of them go in the opposite direction of that as well too. So we'll compare. Really, let's just talk about Lakeside first. What we're doing there, and compare to Davis Circle, how we're going smaller and bigger.
Yeah, so Lakeside, we bought it about 18 months ago. It was 78, 79% occupied. We've done incredibly well. We're now at 92%, and we're touring regularly to basically get to 100%.
Yeah. The most recent one we leased was a roughly 11,000 square foot medical tenant that took that space. So a lot of times we get the question like, who is the tenant?
Who's a flex
that's
user?
going to move
Yeah.
this? What's going in here? And it's like, well, it could be an auto shop, or it could be a medical tenant, or it could be an autism center. It varies significantly, which is a little bit of a challenge, but that's why we feel like we can go buy this stuff at a good basis, because that unknown is one of the risks that we're taking.
Well, the key word here is flex. And not only is it a flexible building, meaning it can be part warehouse, part office, but it's also a flexible user. So it really opens the market up to really a lot of different uses.
Yeah, so this lease at Lakeside is a medical imaging group, and they want the longest really lease that they can get, right? We're not necessarily trying to sign 20-year leases. We're backing down a little from that. But they're going to go spend a significant amount of money to go put imaging and MRI machines into this place, more so than even we paid for the building. Right. And on a per square foot basis.
To your point about the 20-year lease, what we've seen in the market is that people that signed 20-year leases 20 years ago with 3% escalations, they signed that lease, say, at $3, $4 20 years ago. And with those 3-4% escalations, rents are only $7, $8 now. Math isn't probably perfect, but it's give or take where it's at. And the market's closer to 12 to 14, and they can't capture the value because they're still locked into a long-term lease. So we like looking at the 5 to 10-year window. And we'll go as short as 3, but really the 5 to 10-year window is our sweet spot because it gives us the flexibility to keep up with the market.
Yeah. Well, if market rents go up at 7% and you got fixed at 3%, you're going to lose some value there over pretty quickly in 2 or 3 years. So
exactly,
we don't want to go super long on it. But if a tenant's going to go spend a significant amount of money, they need to have that guarantee that they can have the space.
Right.
So Lakeside is we took spaces and divided them into smaller suites. We're able to lease those pretty aggressively. We're doing really well there, and we're just excited about how that business plan is working out there. So that one is performing well and making distributions. So we're happy there. Let's take the other angle and let's talk about it. We have a deal up in Marietta, Georgia, which is just northwest of Atlanta, and that one was 2 tenants. It was already divided in half. And this one's kind of going the other direction. If we can get a larger tenant that's going to take more space, that would be great. Typically, that takes a lot longer to go through the leasing process. Typically, they're going to want a very specific build out for them. Someone that moves into 5,000 or 8,000 square feet, they're like, hey, here's the box. And like, okay, we'll go do our thing in here. We're ready to go. We want to get in there. As soon as you go to 15,000, 20,000, 30,000, you've got very specific users. So at this property up in Marietta, which is Davis Circle, we're talking, we had 2 suites and we have 1 tenant, probably one of the most challenging evictions that we've ever done on any of our assets in 15 years.
So the tenant was what, food distribution? So they had a lot of food in the refrigerators
And just
in the
lying
shelves
around
and just everywhere.
It was, it wasn't the prettiest.
So part of the eviction was removing spoiled food, which you can
And
imagine
lots of it.
the smells and the environment that you're in when you're
Yeah.
removing
We're
spoiled
gonna put
food.
some video up here to show you what that looked like. But we got that done, and now we have the whole suite that was empty, and we're talking with the other tenant that's on the other side of the building, saying, "Hey, do you want to take this space? Is this a space you can just move into?" It's now that it's cleaned out, it's pretty much able to be moved into, and seeing if they want to do that. That's one route. Anytime we do have space, we're always asking the other tenants in that complex, like, "Hey, do you want this space?" before we go take it out fully to market. So we're in that phase of it right now. We bought that deal. Again, they were paying a couple dollars per square foot 18 months ago when we bought it. So we are right on track with what the plan is there. But it was a rough one to get everyone.
Yeah, that was an interesting deal because we bought it 18 months ago, and frankly, there wasn't anything we could do
they
until
had a
this
lease.
lease expired. So we were really just parked, collecting whatever money we could from them. They stopped paying their rent, some period after us buying it. But
Yeah.
At that point, we file eviction. We had to wait for them out. But frankly, we're on track, even though we haven't done much in 18 months. That was the plan, was to wait for that lease to expire, get them to either increase their rent or move, and then get the existing tenant to take over the rest of the space.
And that's where we mentioned at the beginning, kind of the three steps in the investment cycle with the industrial properties. Like, we're in the middle of that second step right now. We'll have the suite white boxed and ready to go for a tenant, and then hopefully the neighbor or in the complex takes it, or we can go to market with it and then get to that third step, which is a fully stabilized rent roll. Mm-hmm. So we're right in the middle of that, and it's going on track, and it's a good deal for what we want to be doing with it. So another one that's interesting is Pleasantdale Flex. That's a deal that we have here on the northeast side of Atlanta. And this is one where we are in the middle of that second step. So we have a 19,000 square foot suite, which is big for us. That's one of our bigger spaces that's available. When we first got it cleaned and white boxed and ready, we were like, okay, we're going to divide this thing up into our standard sizes because that's what we feel aggressive and comfortable with to lease. However, we got 2 or 3 pretty solid bites on potential leases at that 19,000 square foot range. Ultimately, we probably lost 3 or 4 months of negotiations with those. Those tenants did not move in. In the end of the day, the truck turning radius of the back parking lot didn't work for them. So that's why they didn't do it. A very specific reason for a big 18-wheeler truck versus our standard user is using a box truck. That's kind of where we're going. You're thinking, you're driving down the highway, you see you got 50 18-wheelers lined up at a building. That's typically not our user. Our user is more the 20-foot box truck that's coming to the back of their location. And our deal works just fine for a 20-foot box truck, but it is not great for rolling in dozens of 18-wheelers. So that's why that 19,000 square foot tenant ultimately didn't work. And now we're in the process of saying, like, okay, we're going to divide it up. We're going to go to the suites that we know we can lease, but we did lose some time there because of that, of kind of playing the lease negotiation game. If we could have gotten one of those bigger ones, it would have been great. However, we didn't. So back to the original game plan there.
And a good example of where that worked out in our favor was over at Dawson. It was the biggest lease we ever signed, 40,000 square feet. We had a tenant, Pure Air, come in, and they wanted the space. It took us 6-9 months.
We're just finishing it up.
Well, it took us 6 to 9 months to just get to a lease.
Yes.
And then it took
To
us
get through the
another
negotiation.
9+ months to build out the space, and they don't take possession and start paying rent or even start their concession time until after that. So it'll probably end up being, 15, 18 months before, from the time that we said both the tenant and us said we want to work together, let's do this,
Yeah.
to the time that they start paying rent, it's probably close to 18 months.
Yeah, it's a long windows for such a big lease.
Right. Versus like a 3,000 to 7,000 square foot lease, it takes about a month to sign the lease. You probably get 3 months of concessions, and you have cash flow within 6 months.
Yeah. So let's talk about tenant mix. At Dawson is a good example. We have one really big building, great tenant that's there a long time to go do it. And we had another building that was half the size. And originally we signed a lease there with a startup company. One of the few times we saw a startup new business go into one of these spaces, and that ultimately didn't work. They paid a little bit of rent for a few months, and then business didn't work. So mostly all of our tenants are established companies that are expanding locations. It's not new business startup. So everything is an existing business that's expanding and taking another location. That's our go-to tenant mostly all the time. But at Dawson, end of third quarter wrapping up, we've got multiple LOIs that we are trying to wrap up. But again, these are fast moving. It's not an 18-month cycle. These are LOIs that we've had out for 2-3 weeks right at the end of the quarter here, and we think we will be able to get everything signed and completed for the fourth quarter so that we have leases in place there. So in the same amount of time on one building that we signed a lease and got the tenant moved in and moved them to now they're paying rent, one of the other buildings with smaller users, we had a user come in, not work, pay some rent, and leave, and now we're already on track to refill it in that short amount of time. So the cycle on the smaller suites is much faster. We're also a little more comfortable with that. We like that faster movement of being able to lease stuff. So Dawson will be in good shape going into really we should have all that wrapped up in the fourth quarter on all those leases and go into the first quarter paying rent. So let's look at what we can go into next. We talked about Forum a little bit. You mentioned that, and that's a deal we bought Forum Flex
About a year ago.
Yeah, about between September and October of last year, and we feel at about the 15-month mark we'll have everything divided, and we should have everything fully leased and going in really at the end of the fourth quarter. So we are on track with our plan there, but only because we made the smaller suites, and those really leased as soon as we even talked about, hey, we're going to make them. We had tenants coming in to do them. So.
And this is a property we bought at barely 60% occupancy. It was 2 buildings. One of them was better occupied than the other. The one that we're in right now was fully vacant. And we, really in 15 months, we fully leased the building. So that's another reason we're so bullish on the demand for this kind of space.
In those tenants, we've got one is a training facility. So we're seeing a lot of personal and specialized training centers. It's not a startup. It's like their 120th location.
Yeah, fitness training.
Yeah, fitness training. So by no means a startup. This is a new location that's a startup, but the business is, national business. So they have a lot of locations. And the other one is an expansion of a janitorial service location that they're going to have. So they really are the true flex user of. They need some office and conference room. They also need some storage. So they'll be in here as well as one of the tenants. So excited about getting them on board. They're doing the build out right now. So I have some pictures of that. But okay, let's go into just tenant spending. Let's just touch base on that topic real quick of what that looks like, because it's just very different on every space. We mentioned it at Lakeside, but at Forum, our tenant spend here, most of our tenants, they just want the space. They're like, how fast can you just get me the space so I can do my thing in there? And we need to have our fire rated walls. We need to have a bathroom. But other than that, they're taking the space and they're rocking and rolling, going with it. Whether they're putting in racks to store stuff or whether they're just bringing in furniture is really all they need to get moving. But those are, again, the smaller square footage. Those are really quick move-ins, quick decisions by those organizations.
We saw the same success at our Graham property up in Charlotte. It's not one of our flex properties, but it's designed similar to one. And half the tenants that came in just took an open room. They put a couple desks in, maybe they put some divider walls up, but we did not have to build out for them. All they wanted was heating, air, and power and outlets, and they could handle the rest.
Get going.
Yeah, I mean, frankly, they just didn't want the restrictions of having too many walls in because they didn't know how their business was going to fit into it. One's a photography studio; he just wanted an open space so he
Yeah.
could take pictures.
Yeah, it's pretty cool.
Yeah.
It's cool to see. Although one of our favorite parts is just seeing the different businesses and how they use the space and how they get in there and act quickly and move forward. So that part's pretty cool. So overall on the investment front, we're still sticking with the plan of we're trying to find as much kind of underutilized space as we can, divided into those 5 to 7,000 square foot suites. And it really, we're opportunistic on how that gets divided up. We've got to see where the windows and the door access points are.
Where the bathrooms are. We don't want to rebuild bathrooms over and over and over again.
Yeah, you've got to be creative in how you line that space up. And maybe it makes sense for it to be 3,000, or maybe it makes sense for it to be 6,000, because that's the most efficient way to get the work done. And then we're working with a tenant. If they need 5,000 and we have 6,000, it's like, well, let's do 6. Or if they can work with 3, they can work with 3. But we're going to divide the buildings up to be the most efficient use of the least amount of walls, the least amount of new bathrooms that we can to make these spaces work. So we're seeing a good amount of the product that coming in at these price points that we can execute on, and we're really going to focus on the 2 exit points of we have the white box phase done or we have the leasing phase done. That's really our 2 drop-off points. So overall, going forwards, we do feel like there's a lot of opportunity in the market. There is no new supply, so none of it's getting built. We have to go create it all, but there is the opportunity continually to buy stuff that has a $3 or $4 square foot tenant. There's years of those buildings that are still left in the market. Some of them are on the market, and you mentioned like it has a 3 or 4 year lease. That's just too long for us right now. Wait till that lease becomes shorter, and then we are the buyer for that kind of product. So, cool. All right. Thanks for watching, everyone. If you have any questions, please let us know. We're very excited about this office to industrial flex, or the industrial flex space. So please let us know if you have any questions, and we look forward to talking. Thanks, everyone.